Hi there, I got a new investment idea from a viewer which is about Grenke. The market cap is about 643 million euros, PE ratio about 9.6 and the dividend yield close to 2.9%. And as you can see, most important thing, the stock price from 2018 and also from 2020 has declined quite a lot, a decline over 80%. And the viewer who recommended this company, he said that it's very undervalued. So I said if there is demand, I'll make a video. For sure, not many people will watch this company because there is no demand for it. But because I've seen this massive decline in the stock price over the years and the PE ratio and the dividend, I said maybe this is a real opportunity. In other cases, if there is no demand and that company is not a real bargain, you can join my membership and there you can ask me to analyze this company. So let's begin the analysis for this company, Grenke. Maybe you wonder what they do. First, they provide financing to enterprises. Leasing, more exactly. And if you look at their history, you can see that they started in Germany. By the way, this is a company from Europe, Germany. They started in Germany. They expanded in other countries. And more recently, 2020, in the United States. And they plan to expand even more. Future core markets, Canada and the US. And of course, Australia. So it seems that they have more growth ahead. Now, what you have to be aware of this company, the most important thing is their earnings, future earnings. And of course, the losses they have on their loans. So, if you look at their guidance for 2025, they expect their earnings to increase from 70 million euros to between 71 and 81 million euros. And also their leasing new business to increase. But the most important thing are their earnings. If they can increase those earnings more in the future, so for the next year, this year 2025, they expect a small increase, that's good. And another important indicator is their loss rate. The lower the better, because they can increase their earnings. They expect the loss rate to be about 1.6%. Now, if you try to value this company, you take their earnings and look how much they can grow in the future. And then the next question you should ask is, what will they do with those earnings? So, if you look at 2024, what they did with their earnings, you can see that most of it were used for buybacks and dividends. And that's good, quite good. If they continue to do more buybacks, especially at those prices, you can have a double from this level. And of course, also a nice dividend around 3%. And if you wonder why the stock price has declined so much from its highest peak, is because, look here, of their dividend. 2019, the dividend was around 80 cents. Then a huge decline to 26 cents in 2020. And back then, the stock price has declined a lot. It started the decline in the stock price, over 60%. And then it has continued to decline even more. And if you look at their dividend, huge decline, an increase, and then another decline. And for 2024, of course, another decline from 47 cents to 40 cents. The payout ratio is about 25% of their earnings. Now, if you look at their income statement, here you can see the average number of shares outstanding has decreased from 46.4 to 45. So this is good, the first step. And also their dividend, if you look over the years, it has increased just a little, from 20.9 million to 21.6 million. Now, as they reduce the number of shares, the dividend can get higher. Because if you have less owners, you get more in dividends. Now, to assess the future outlook of this business, as I said, the most important thing is their earnings, if they can grow more in the future. Because if you look at their history, their earnings over the last 5 years, you can see that they were around 93 million, 99, 90, 92, and 75. So there wasn't a huge growth in their earnings. Of course, in the past, before 2020, their earnings reached more than 150 million. So, to assess the future value of this company, you have to look into the future. If those earnings can increase more in the future. If they reach 100 million in earnings, then of course, the stock price can double from this level. There is no doubt. To double. But you also have to ask yourself if they can do it. At the current level, if they continue to increase their earnings, you can have a double. I don't expect more than that. Of course, fair value. The stock price can go back to $60 or $40. Let's say $26. The stock price can double from this level based on the fair value. If you have overvaluations, then that will be good for you. But let's focus on their future earnings, if they can grow more in the future. And for that, you have to look at their business, how they operate, how they make money. So they have interest income, their expenses, and their operational costs. And at the end, their earnings. Now, the huge problem I've seen with this company is their huge debt, especially in 2020, 2019, right before, they start to increase their debt. And now it's over 4 billion. 4 billion. And if you check on their balance sheet, here you can see that they have in cash over 974 million euros, so higher than the current market cap of 643 million. But if you look at their liabilities here, they don't write debt, but financial liabilities. You see here current liabilities and non-current liabilities. And you can see that their current debt is around close to 3.2 billion. 3.2 billion. And the long-term debt, 3.3 billion. And this is quite a lot. As this company is making, their final earnings are only 70 million, between 70 and 80 million euros. And the short-term debt is around 3.2 billion. This is a major problem. Of course, they can get rid of this debt by repaying with another debt. They take a loan of 3.2 billion and pay this debt on the short term. They can do that. The problem is you have to ask yourself is the interest rates. If they remain high, around this level, 4% or 3%, depends, maybe they get lower, then their cost of debt will be higher and their earnings in the future will be affected. If the interest rates get lower, so their expense rate will get lower and their final earnings will get higher. Now, when you see 6 billion, over 6 billion in debt, you might wonder if this company can increase its earnings more in the future. This is the first thing you have to be aware. Then you add their expenses. You look at their expenses, right? Here, staff costs, which year over year has increased. Of course, also their revenue has increased a little, income from operating the business. But you have to be aware because if their operational expenses go higher, they increase higher than the revenue, also the interest expense, the interest they have to pay on their debt gets higher because of more debt, then the final earnings will be affected. And this is the main risk of this company. Their huge debt and the way they operate this business. And of course, how they can handle this risk. Because you see a loss rate of 1.6% for 2025. Which has been an increase from 2024. If you check the loss rate for 2024, I don't have it here, but if you look on their income statement, here, result from claims settlement and risk provisioning. You see an increase from 90 million to 141 million. And if these losses continue, their final operating earnings will get lower. And you already see operating results, 90 million, a decline from 112 million. So the increase in their earnings are not that easy. I mean, they won't grow by 5-7% in the next 10 years. You might have some ups and downs, but everything depends on the management. So when you invest in financial companies, the management is quite important. How they handle the risk, if they can keep costs low and increase their earnings. But if they have only a small mistake in their operations, their earnings will decline, will get lower, and so the stock price. And of course, you also have to take into account the macroeconomic environment, the interest rates. So from this level, based on my valuation, conservative evaluation, the stock price can double only if the earnings increase a little from 70 million to 100 million. You can have a double. But if they make a mistake, the stock price may be flat. And of course, the risk, if they face more problems with their debt, then the stock price can continue to decline. So from this level, the price seems fairly valued as long as they continue to increase a little their earnings. The stock price is fairly valued for a 10% annual return. Now, as this company is a little bit risky, I mean the risk is quite high with that debt, you also need a margin of safety. So in my opinion, if I were to buy this company, I wouldn't pay this price. I will ask for a margin of safety. I will demand for a higher margin of safety, below 500 million. Because you never know what will happen with their debt, with their expenses, and of course their loss rate. So you want protection. Now, if you have a diversified portfolio and you want to invest only 1% of your money in this company, then you can take this risk. Because maybe from this level, the stock price, as I said, with good tailwinds, the interest rates get lower, the stock price can go back to $50. You can have this opportunity, the upside, the reward. That can happen. But if you focus also on the risk, first on the risk, you'll see that the stock price is not that undervalued. So it's up to you how you want to invest in these companies. If you prefer risk, then of course from this level the stock price can more than double. So that's it for this video, and if you have other questions, please let me know in the comments.